Revenue is vanity, profit is sanity, cash is reality. And Tesla just had the biggest revenue quarter in its history, with almost none of the other two. $28.24 billion in 90 days, which pushed trailing 12-month revenue past $100 billion for the first time ever, and an operating margin of 1.4%. A penny and a half kept out of every dollar that came through the door, which matters to us even if we never went looking for Tesla, because if you hold an S&P 500 fund, you already own some. And here is where it gets strange. 3 weeks before that July 22nd filing, Tesla published its delivery numbers, and it had sold 480,000 cars, 74,000 more than Wall Street expected, its best second quarter ever, and its first real growth in 2 years. So this is not a company nobody wants to buy from. Whatever happened to the money happened somewhere between the customer paying for the car and Tesla counting what was left. So the story writes itself, right? Record revenue, collapsing profit, that's a company selling things for less than they cost to make. And the entire internet spent the following week explaining that Tesla had finally been forced to discount its way to volume. Well, no. Here's what else landed in those 90 days. Adjusted earnings came in 38% below consensus. Operating income fell 57%. Free cash flow went negative for the first time since early 2024, capital spending more than doubled, and the Model S and the Model X, which between them ran 25 years and 610,000 cars, were discontinued in May to clear floor space for a humanoid robot that nobody has built yet. And on the earnings call, the chief executive of a company with $100 billion of annual revenue was asked whether he might merge it with a rocket company, and did not say no. 2 of those things Tesla did to itself, and one of them is a law that got passed. So is this the engine underneath finally seizing up, or is it just the accounting letting us see what we've been buying all along? So did somebody just break the factory in the middle of the biggest revenue quarter the company has ever had? Well, the discount theory was the first thing I went looking for, and it's also the first thing that falls apart, because if you buy volume with price cuts, there is exactly one line where that shows up, and it shows up immediately. The delivery number was 480,126 vehicles, against a street consensus of roughly 406,000. That's 74,000 cars, 18% above consensus, up 25% on the same quarter a year ago, and up 34% on the quarter immediately before it. And we need the context for that to mean anything, because Tesla did 1.79 million vehicles in 2024, down 1%, then 1.64 million in 2025, down almost 9. 2 consecutive years of a growth company shrinking. So this wasn't just a good quarter, and I want to be clear about that before I take anything apart. It was the first genuine reacceleration the company had shown in 2 years, and it wasn't close. Now, if that volume was bought with discounts, gross margin is the line that pays for it. Gross margin came in at 16.8%, against 17.2% a year earlier, 0.4 of 1 percentage point. That is not a company that discounted its way anywhere. That's essentially flat, and it's the single most important number in the whole filing, precisely because it's so boring. Because everything else on that page is carnage. Adjusted earnings came in at 33 cents a share against 53 expected, which is a 38% miss at a company where expectations are more or less the product. Operating income fell 57%. To $398 million, and operating margin went from 4.1% to 1.4%. Free cash flow went to minus $1.1 billion, which is Tesla's first cash-burning quarter since early 2024. A year ago, the same 3 months threw off $146 million, and the quarter immediately before this one threw off $1.44 billion. Capital spending more than doubled to $5.79 billion. There's still $43.5 billion of cash on the balance sheet, so nobody's passing a hat around. And I want to be fair to the delivery beat before I lean on it. Tesla built 451,000 cars in those 90 days and delivered 480,000. So 28,000 of them came off a lot rather than off a line, built in earlier quarters and sitting there long enough to have opinions. Set that against the beat and it's 38% of it. And that isn't a soft number or somebody's model. It's 2 figures subtracted off Tesla's own production release. It's still real revenue, it just isn't new manufacturing. There was also a tailwind Tesla didn't create because the Strait of Hormuz closed in March and wholesale gasoline put on 30% inside that 1 month, and expensive petrol reliably makes electric cars look clever. And that one has not unwound. The AAA national average is $4.09 this week, against $2.96 a year ago, which means the help Tesla got in the second quarter is still arriving in the third. But none of that touches the profit, and this is the bit that took me a while. The gross margin barely moved, which means the money didn't disappear in the factory or on the sticker. It disappeared underneath, in the space between gross profit and operating income, and there are only 2 things down there big enough to do it. One of them, Tesla never touched. A single line item collapsed, and line items collapse constantly. So the whole job of a serious investor is to look through the noise to the business underneath, right? Well, not this one, because it was never noise. For most of a decade, it was the margin. $146 million, down 67% from $439 million a year earlier, down 62% from the $380 million booked 1 quarter before, and the lowest that line has printed since 2020. Here's how the machine worked. Regulators told automakers to hit emissions and fuel economy targets, and if you missed, you paid penalties. Unless you bought surplus credits from somebody who had overshot. Tesla only builds electric cars, so Tesla overshot by construction and piled up enormous surpluses of compliance credits it could never use itself. It sold them to Ford, to GM, to Stellantis, to anybody short. Those credits cost essentially nothing to create, so every dollar of that revenue fell more or less straight to the bottom line. It was a product with no factory, no supply chain, and no unit economics to optimize, which quietly made it the most profitable thing Tesla has ever sold. And it was structural rather than incidental, because for years, a meaningful share of Tesla's reported profit was competitors paying Tesla to exist. Every time Ford sold a truck it wasn't really supposed to be allowed to sell, a slice of that went to the company building the cars it was supposed to be building instead. In 2024, that line peaked at $2.76 billion, then came down to $1.99 billion across 2025, and then this year it went off a cliff. 595 million, 439, 417, 542, 380, 146. And Tesla did nothing wrong here, which is the part I think gets lost in most of the coverage. The $7,500 federal EV tax credit expired at the end of September 2025, and then a change in federal law zeroed out the penalties automakers pay for missing fuel economy standards. So remove the fines, and what is a compliance credit actually worth? Roughly what a parking pass is worth in a lot that stopped charging. Rivals were buying those credits to avoid fines, so demand for them didn't soften. It was legislated out of existence. The buyers didn't get poorer, they got excused. A year ago, that line was worth almost 2 full points of Tesla's total margin. This quarter, it was worth half of one. Operating margin fell 2.7 points across those same 12 months. So when I line those two up, the credit collapse accounts for a little over half of the worst margin quarter in 6 years. And not one person in Fremont or Austin could have prevented any of that half, which is the good news and the bad news in the same breath because it's permanent. This isn't a cushion that got thinner, it's a cushion that got taken away. And 146 million could be a floor, or it could be a landing on the way down. 2 quarters ago, it was 542, and it only explains half, because the other half, Tesla did entirely on purpose. So half of the ugliest margin in 6 years is a law that got passed, and Tesla is entitled to be annoyed about it. The other half is a decision. And decisions are the part we're actually underwriting when we own this. So let's run the numbers and find out. Did Tesla start spending like this because the future arrived early, or because the free money left and somebody needed a story to put in its place? The other half is Tesla spending enormous money on robots and AI, which is the entire reason anybody owns this instead of Toyota. So is objecting to it not a bit like buying a lottery ticket and then complaining about the dollar? Well, mostly. Operating expenses jumped 47% to $4.35 billion, while revenue grew 26%. And when your costs run at nearly twice the pace of your sales, the middle of the income statement is where you find the wreckage. Capital spending was $5.79 billion in 3 months, up 142% on a year ago, and full-year guidance now sits above $25 billion, against the $8.5 billion Tesla actually spent across the whole of 2025. Roughly triple in 1 year. Tesla was specific about where it goes: robotaxi infrastructure, Optimus production lines, semiconductor fabrication, solar manufacturing, battery materials, lithium refining, and AI compute. And Musk's own description of it on that call was that this is a massive CapEx year, which is the most honest sentence anybody said all evening. Translated, it reads, "We know this is expensive, we're doing it anyway, and please don't build a model around it." But not all of that 47% is building anything, and this is where I think most of the coverage went wrong. A meaningful chunk of the increase is stock-based compensation tied to the CEO pay package, which is a real expense that lands on the same line as the robots. No amount of stock compensation has ever assembled one. Filing the whole jump under AI investment overstates how much of this quarter's cost increase actually bought equipment. Then there's the third squeeze, which almost nobody put in a headline. Average revenue per vehicle fell to about $42,730 from roughly $45,345 a year earlier. Tesla retired the Model S and the Model X entirely and pushed cheaper versions of the Model 3 and Model Y to carry the volume. More cars, less money per car. And underneath all three of those sits the thing that actually changed my read on the quarter. For 6 years, this bet was funded out of profit because the car business threw off enough cash to cover whatever came next. And this quarter, it did not. So the bet is being funded from the balance sheet instead, which is a completely different animal wearing the same story. And Tesla told us where it goes after that, because alongside the CapEx number, the company said it is pursuing up to $30 billion of debt capacity. That's the line I'd underline in the whole quarter. A company that spent 6 years explaining it didn't need the capital markets has quietly gone and booked the room. And if we're going to hand a company negative cash flow, $25 billion, and a line of credit bigger than that, we would want some evidence that the thing it's building actually works. And you don't need the robots for that, because the bull case is already sitting in the filing, right? Well, a fair amount of it genuinely is, and it's the one version of this that doesn't require you to believe a single thing Musk says about the future. Active full self-driving subscriptions rose 56% in the quarter to 1.48 million, which is recurring software revenue attached to hardware the customer has already paid for at margins no car sale can go near. Cumulative paid robotaxi miles hit roughly 2.25 million by June, up from essentially nothing in mid-2025. Unsupervised service is running in Austin, ramping across Miami, Orlando, and Tampa, with the network live in 7 metro areas. Full self-driving also cleared its first European regulatory approval and went live in 5 EU countries during the quarter, in a market that has been closed to it for years. And the energy business, which nobody ever wants to talk about, did $3.1 billion in revenue, up 13%, deployed a record 13.5 gigawatt hours of storage, and ran at better margins than the cars. The least discussed division is the one behaving most like the company everybody claims they want Tesla to be. And services and other, which is charging, insurance, used cars, and parts, did $4.5 billion and grew 50%. Better than twice the pace of the cars it's bolted to. None of that requires a robot. Here's the hole in it though, and it's the number I most want and cannot find. Tesla reports the miles, but it does not report revenue per mile, and it does not report cost per mile. So nobody outside the company knows whether those cars make money. Not Wedbush, not Wells Fargo, not anybody on financial YouTube, and that includes me. Anyone telling you otherwise is guessing, with excellent posture. Then there's Optimus, which is where the bear case gets its sharpest edge, because as of the July 22nd filing, production has not started. The deck says first-generation production lines are being installed in anticipation of production this year, and that is the whole disclosure. No start date, no unit count, no price. Tesla has never disclosed a single verified production unit, and the track record here is not encouraging. Musk predicted roughly 10,000 robots would be built in 2025, and by January admitted that 0 of them were doing useful work inside Tesla's own factories. His own description of what comes next is 10,000 unique parts, no existing supply chain, and the hardest product Tesla has ever tried to manufacture at scale, moving at the speed of the slowest, dumbest, unluckiest one of those 10,000 parts. And that's his phrasing rather than mine. Meanwhile, the floor space is already spent. Model S ran 14 years, Model X ran 11, and between them they moved more than 610,000 vehicles. Both were discontinued in early May, to clear room for the thing with no start date. And we've all seen this movie before, because everybody who panicked at Meta in 2022 got destroyed by the recovery, right? Well, yes, And this is the comparison I get sent more than any other, so it's worth doing properly instead of name-dropping it. In 2022, Mark Zuckerberg redirected an enormous amount of Meta's capital into Reality Labs, a division losing well over $13 billion a year, building legless avatars for meetings nobody wanted to attend. The market's verdict was brutal, because Meta lost about 64% of its value that year, including a 25% collapse in a single session after October earnings. The consensus was that the founder had lost his mind and was setting fire to a perfectly good advertising business. From that low, the stock more than quadrupled. So the lesson everybody took is the one I've heard applied to Tesla all month. When a founder-led company redirects massive capital towards something the market can't price yet, the market prices it as destruction, right up until it doesn't. And it breaks in two places, and both of them cut the same direction. Meta's core business was throwing off enormous free cash flow the entire time it was spending, so every metaverse dollar came out of profit. And Tesla's core business just went cash flow negative. The second break is bigger, and it's the part people misremember. Meta did not get rewarded for spending. Meta got rewarded for stopping. Zuckerberg spent 2023 cutting headcount, killing projects, and calling it a year of efficiency, while the metaverse slid quietly to the back burner and AI took the front. The recovery came because the market decided the founder could still be disciplined. Tesla is doing the reverse because capital spending guidance went up, not down. So if the Meta analogy holds, the buying opportunity isn't the quarter the spending starts, it's the quarter management blinks. There's also the case nobody in the bull camp brings up. General Motors put more than $10 billion into Cruise starting in 2016, ran real driverless vehicles on real city streets for years, and at the end of 2024, pulled the funding and shut the robotaxi program down. A decade and a fortune, and the answer was still no. All of which sits on top of a stock trading at about 160 times forward earnings, and closer to 280 times the last 12 months it has actually reported. Ford is at 9, General Motors is at 6, and the spread on Wall Street tells you how unresolved this is. 47 analysts cover this stock. Dan Ives at Wedbush is at $600, built on FSD monetization and Optimus scaling. And the low end of the street is 125, which prices in a 59% fall from here. Same company, same filing, a $475 disagreement. But even at 125, against the same forward earnings everybody else is working from, that's about 65 times, which is still 10 General Motors. The most pessimistic analyst covering this stock still thinks it's priced for a future that hasn't arrived. They just disagree about which future. And on June 30th, Michael Burry disclosed a short at $416.22, one of 5 he opened that day against what he called an AI and semiconductor bubble. Here's how I'd leave it. Tesla stopped trading like a car company years ago, and everybody knew it. And the market was completely fine with that, because the car business was quietly profitable enough to fund whatever came next without anybody having to look closely. The second quarter of 2026 is the quarter that stopped being true. Washington took away the free money, and the spending got big enough to show up in the margin line and the cash flow statement at the same time. Now the bet is sitting there in public, every 90 days, where anyone can read it. That doesn't make the bet wrong, and this is exactly the kind of read that ages horribly because Meta's looked insane too, and the people who panicked missed a quadruple. We might be completely wrong about which half of this quarter turns out to matter, but we can't own this for the cars anymore and treat the robots as a free option on the side. As of this quarter, we're paying for the robots, directly out of cash flow, on a timeline nobody has committed to. That's not a worse investment, it's an honest one. If this helped you make sense of Tesla's second quarter, hit subscribe so we can keep running the numbers.